Imagine this. You've worked abroad for years, contributing to a pension in your host country. You feel proud, thinking it'll fund your retirement. Then tax season in the US hits. Suddenly you discover the IRS still wants a piece of it. Shocking, right? Well, today we'll break down foreign pensions and what every expat needs to know. By the end, you'll walk away clear on how the IRS treats these pensions, what forms you may need, and how to avoid penalties. Most Americans abroad assume that their foreign pension works like a 401k or an IRA back home. Unfortunately, the US tax rules don't play that way. Treating a foreign pension the same as a US plan can trigger big mistakes. Mistakes that can cost you thousands in penalties and taxes. Take Sarah, an American living in Germany. She contributed faithfully to her German retirement plan, thinking she'd defer US taxes just like her old 401k. Then she filed her US taxes without reporting the pension. A year later, the IRS sent her a penalty notice, thousands of dollars, because she failed to file the FBAR, the Form 3520, and the Form 8938. She didn't owe the US tax yet, but missing the forms created the penalty. This happens all the time. A foreign pension basically means any retirement account set up outside the US. It could be through your employer, like a company plan, or a personal pension you pay into for yourself. Now here's the kicker. Foreign pensions rarely qualify for the same US tax benefits as 401ks. The IRS often treats them as a foreign trust, especially if it's a personal pension plan and not through your employer, which triggers extra reporting on the Form 3520 and Form 3520A. Great question. Expats ask this every day. Short answer, yes, most foreign pensions face US taxation. Why? Because only pensions organized in the US qualify for tax breaks under Section 401 of the Internal Revenue Code. That means your contributions often don't reduce US taxable income, and growth inside the plan may not be tax deferred. Now don't panic yet. Some exceptions exist. If the US has a tax treaty with your country, the treaty may let you defer income, deduct contributions, or exclude employer contributions. For example, in most tax treaties, Article 18 covers pensions. But not every treaty works the same. And the IRS includes something called a savings clause, which lets them tax US citizens anyways. So you need to read your tax treaty very, very carefully. Another common question, do I need to include my pension on the FBAR? The safe answer, yes, report it. The penalties for leaving it off can hit $10,000 per account per year. The time you spend gathering pension balances costs far less than that fine. Here's some good news. The IRS released Procedure 2020-17, which exempts certain tax-favored foreign retirement trusts from some of the toughest reporting requirements. That means if you qualify, you can avoid Forms 3520 and 3520A. But, and this is huge, you must still report income and file FBAR or the Form 8938 when it's required. So what should you do? Identify whether your pension qualifies as a trust. Check if your country has a treaty with the US. Always include it on your FBAR and FATCA forms. And finally, get professional help, because one mistake can wipe out years of savings. Don't gamble with your retirement. At Tax Samaritan, we help expats worldwide report pensions correctly, minimize taxes, and stay penalty free. Click the link below right now to request your free expat tax quote. Book your free 30-minute consultation with me or my team today, and upload your files securely from anywhere in the world. We'll handle the IRS so you can focus on enjoying your life abroad. Before we wrap up, I'd love to hear from you in the comments. Do you currently contribute to a foreign pension? Have you ever worried about reporting it to the IRS? What questions do you want answered in our next expat tax video? Drop your questions below, and don't forget to subscribe so you never miss an update.